Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. As real estate investors, we make decisions based on more than just the real estate market. In fact, before you're a real estate investor, you're an investor, and it's critical that you understand the bigger picture when it comes to economics. Today, we'll talk about what that looks like, and you'll hear from an amazing guest on the Real Estate Guys radio program.
Stop for a moment. Why are you listening to this show? Are you dreaming of a bigger, brighter financial future? More personal freedom to live life on your own terms? What if there was just one skill that could make it happen? There is. Sales. Robert Kiyosaki says every entrepreneur must be good at sales. It's true for investors too. Sales is how you attract money, people, and opportunities. Sales is the skill used to negotiate deals and lead your team. Sales skills are essential to success. The good news is, it's a learnable skill. The great news is, we've created a 2-day interactive workshop to teach those skills to you. Make plans today to attend How to Win Funds and Influence People, Mastering the Art of Financial Selling. For dates and details, send an email to sales@realestateguysradio.com or visit realestateguysradio.com and look under events. Gain the skills you need to succeed. Email sales@realestateguysradio.com. or look under the Events tab at realestateguysradio.com.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, our co-host and financial strategist, Russell Gray.
Hey, Robert.
It's almost too much to keep up with. Everything that's going on, it's crazy, and then every day there's more. And as a real estate investor, you know, our markets move kind of slowly. We're not in there day trading, right? We look at a market and we court a provider or two and we find a property that works, and then maybe a year or two later we buy another property in that market, right? So it's interesting when we're taking the slow path and are investing, but there's so much coming at us. And I know that we're guilty early on of being completely real estate centric. All we thought about was real estate. All we went to was real estate conferences, real estate, which we love. But we really opened up our eyes after the great financial crisis in 2008, because there were folks out there that saw it. Now, there were a lot of folks out there that had invested a lot more than us and owned a lot more than us and crashed and burned a lot more than us. I mean, we didn't have a good time of it, but, you know, here we are today. At the same time, there was one guy out there who called the great financial recession for the exact reason that it happened. And that inspired us to open up our minds a little bit to think about the bigger economic picture.
Yeah, it really did. And it came down to understanding the very, very important role of the bond market in the financial system. It is where credit emanates from. It's where the price of money or interest rates are set. And when you understand the role of interest rates in the economy, if you have an interest rate, which is the cost of capital, then it's going to affect the pricing of everything. So with an apartment building, for example, if you've got a interest rate on a mortgage of 5%, then you're going to need to have a cap rate above 5% for it to begin to make sense. If the interest rate goes all the way down to 2 or 3, then all of a sudden a 4 cap property might make sense. The problem is when rates go back up again, then all of a sudden that doesn't make sense. And this is where people get stuck in these transitions, because repositioning a property, disposing of a property takes time. And raising rents and improving cash flow, all of that takes time. And if you don't get the timing right with respect to your cost of capital, then you can find yourself on the wrong end of a transition. So the bond markets are very, very important. And then a corollary to that is the currency. Now, we've enjoyed for many, many years a situation where our currency has been relatively strong, relatively stable. And then recently, this thing called inflation, which by definition is a degradation of the purchasing power of the dollar getting weak. That's become a real factor on Main Street. And so these things are related to each other, and they definitely all trickle down onto Main Street, which is what we found. So we decided it would be really, really smart for us to seek out people who understood how these mechanisms work and the relationship between the bond market and the currency and the economy and the financial system and the financial markets. And then once we could understand that, then we could look at the real estate community and say, okay, how are those connected to, supported by, affected by these same factors? And it just allows us to see what's coming a little bit sooner, hopefully enough sooner that we're able to take moves to get into position to take advantage of an opportunity or avoid a catastrophe.
Our guest today is a real estate investor, but really only by default, having been in a couple of his really amazing properties. He primarily focuses on the markets, and back in 2006, he wrote a book called Crash Proof, and it came out in 2007, and he was laughed at by a lot of the traditional financial media and even people in the lending business because he was sounding the alarm, saying, guys, there is a problem coming. Turns out he was exactly right, and it happened almost as he described it in his book. He joined us the first time for the Investor Summit in 2013 and has hardly missed a year. When we come back, you'll hear the latest musings on inflation and other things happening in the economy from our friend Peter Schiff, today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investor Summit. Simply put, it's the highest level event we do, and the content, faculty, and attendees are amazing. If you're serious about taking your real estate investing to the next level, then join us next summer. You'll spend an entire week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all begins June 6, 2023 in Ambergris Caye, Belize. Visit realestateguysradio.com and click on the tab that says Summit to learn more and reserve your spot. We'll spend a sun-drenched week learning and networking with more than 25 class sessions and breakouts, plus small format roundtable discussions, great dinner conversations, and a ton of fun. It's nearly 70% full already, but there's room for you if you go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 21st Annual Investors Summit on Sand.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Now in our 27th year of broadcast, we're talking today about the inflation genie. What's up? What's going to change? What does it mean for real estate? And let's welcome back to the Real Estate Guys radio program a guy who knows a thing or two about this subject, our good friend, Peter Schiff. Hey, Peter.
Hey, how's it going?
Good. How are you, man?
Well, I'm doing all right.
It's tough with everything going up in price. Let's talk about inflation. We had you on the summit last year, 2022, and there was some talk then. You know, obviously inflation was out of control, and there was some talk about, the Fed will bring it back in, and you said, don't count on that. Take us through what's happened and the drastic change that this world has experienced, inflation, not just in the U.S., but everywhere.
Sure. Well, first of all, you have to understand what inflation is, because it's probably one of the most misunderstood terms in the English language. And when you don't understand inflation, well, it's really hard to explain what's going on. But inflation is not an increase in prices. Inflation is an expansion of the money supply or the credit supply. The Federal Reserve in the United States began a deliberate policy of creating inflation following the 2008 financial crisis. So they called it quantitative easing, but the goal of quantitative easing was to create money and then use that money to buy up government bonds or mortgages. And so they created inflation. They basically opened up the spigots and flooded the economy with a bunch of inflation. Now, when you expand the money supply, all else being equal, prices have to go up. Now, sometimes all else isn't equal. Sometimes prices just go down less than they otherwise would have gone down had you not created more money. But also, it depends on what happens to that money as it enters the economy. Its effect on consumer prices could have a lag. So there could be a long period of time between adding money to the economy and that money impacting consumer prices. In fact, what happened in the U.S. for a while is a lot of the inflation was in asset prices. So before it got to the supermarket, it took a detour through the stock market. Stock prices went up, real estate prices went up, bond prices, all sorts of prices, cryptocurrency prices. They were all pushed up by inflation. But of course, nobody owns stocks because they want stocks. They want the goods and services they could buy with their dividends, or when they sell their stocks, they want to take that money and buy real stuff. And as that starts to happen, then the price of that stuff starts to go up. And also what happened is we exported a lot of our inflation. A lot of the money that was printed was sent to China, and China sent us goods. And that the goods coming in from China helped keep a lid on prices because we got the supply. Meanwhile, the money we sent to China, they used it to buy bonds and things like that, financial assets. And so that propped up those prices. But then when we got to COVID, we really kicked the inflation in a high gear because the money presses went into overdrive, because the amount of money we printed during COVID was equal to all the money we printed from 2008 to 2020. I mean, it was actually more money was printed in 2020 than, in QE 1, 2, and 3. And so there's all this inflation. And now in 2021, we're finally seeing the consequences of all the inflation we created manifest itself in consumer prices. And I think that we would have seen a bigger increase had the government had a more honest way of measuring prices, because I think that in prior years, when the government claimed inflation as measured by consumer prices, was 1.5%, 2%. I think it was really double that at a minimum. So it wasn't 2, it was 4, whatever. So there was inflation in prices, you could see it, but the government just wasn't honest about it. But now prices are rising so much that even though they're lying about how much, it's still a big number. And this is going to continue for many, many years.
Well, and I think part of it is you hit on at the beginning, which is understanding what inflation is, but also how it's measured. Part of the lie, if you will, is the fact that CPI, the Consumer Price Index, doesn't accurately reflect true inflation, but there's other indexes. There's a variety of ways. In fact, the way that the government lately wants to track inflation is even less or more disingenuous, I guess. Can you speak to that?
Yeah, well, you look at something like the Personal Consumption Expenditure Index, which has something called substitution, which is a big part of that, not just hedonics, which is in the CPI, which is a big, lie, which supposedly adjusts for quality. But, they never increase for prices for a reduction in quality, but they always decrease the price when they claim the quality has improved. But in the PCE, they use substitution to hide inflation. When you think about it, or when they try to talk to the people about it, on the surface, maybe it makes sense. But anyway, this is how substitution works. They say, well, if the price of steak goes up, you don't buy the steak. You buy chicken instead. And so there really isn't any inflation because you're not paying that higher price. You're just, you're avoiding that. And they're saying we want to measure the money that families are actually spending. That's a better way to measure inflation, because they said people react to higher prices and they substitute less expensive items. And so the government wants to say, oh, steak went up. Let's not count the steak. Let's count the chicken. Oh, that's cheaper, whatever. But that is not an honest way to measure inflation, because there is quality. If I want steak but can't afford it and I have to settle for chicken, that doesn't mean there was no inflation. I was impacted by the inflation in that I didn't get the meat that I wanted. I had to settle for something that I didn't like as much because I couldn't afford steak anymore. So this idea that, we could just substitute, to me, it makes as much sense as saying, well, what if the price of chicken goes way up and you start eating dog food? is the government going to claim, oh, look, there's no inflation. Everybody is fine. They're just eating dog food, but, it's the same price as what they used to pay for steak. So it's all good.
Well, it makes the point, right? So substitution for sure. And then you have, in the CPI, you have owner's equivalent rent, which you can help us understand. But as real estate guys, it doesn't really, it's not rent. It's not a mortgage payment. It's neither of those.
Yeah, I can't help you understand that because I don't think anybody understands it.
Right.
I mean, it's supposedly, the way they get owner's equivalent rent, and this is the biggest part of the CPI. It's like a third of it. They take a survey. They call up people who own homes and they ask them what they could rent their home for. I mean, how do you even know? Like, if you own your home and you live there, how do you know what you could rent it for?
Right.
So they just kind of ask the question. I'm not even sure how they ask it because I've owned homes for a while and I've never gotten that call.
Yeah.
But,
yeah, me either.
Somebody is getting called, right? Somebody is getting called. And then they compare the answers that they gave a year ago to the answer they give now. But, why don't they just use real rent, right? Those numbers are available. They're like on sites like Zillow and stuff. It's easy to look at what's actually happening to rents. Or why don't they use home prices, right? That's, you can see prices. Or why not take an average, half prices, half rents? At least that would be accurate. But they decide to use some completely made up number. Now, at one point in time, they used real numbers. They just don't use them anymore. And I'm sure the reason that they're using these phony numbers is because it helps make the CPI lower, which is what the government's goal is. The government creates inflation, but doesn't want to honestly report how much they've created. We shouldn't even have the government. It should be an independent agency that tracks prices. Because it's like talk about the fox guarding the hen house.
Yeah.
How are you going to have the government? It's like, my dad used to say, it's like, the mafia doing a report on crime.
Yeah.
And they're going to use the results to decide if they need more police. And then the mafia says, oh, there's no crime in this area. We don't need any police.
It's interesting that we watch what the Federal Reserve does, obviously, and all the lead up to the FOMC and those announcements. And, you've always been ahead of that, kind of counseling us as to here's what's coming up and here's what they're likely to do. But there's just not that many tools in their toolbox. Back when we saw interest rates on the street level at 18%, the Fed came in and made some pretty major moves to combat that. But then anyone who's invested in the last decade hasn't really seen real interest rates, right? They've been kept down, you can say artificially or whatever. So real estate investors especially have gotten used to cheap money. And now it's a big wake-up call because all of a sudden mortgages are twice as expensive as they were.
Yeah. And first of all, the idea that, the Fed has tools to fix the economy, the Fed doesn't have any tools. I mean, the whole idea that the Federal Reserve is there to manage the economy is nonsense. That's not why it was created. Nobody established the Federal Reserve to try to manage the economy or fight off recessions, stimulate. I mean, that wasn't the purpose of the Federal Reserve. Somewhere along the way, it was given these mandates of maximum employment, low inflation, but it didn't have those mandates when it was conceived and initially created. All it was supposed to do was, rediscount commercial paper. It was supposed to be a more reliable way of transacting than before the Fed, when, we had all these different banks. And, if somebody was in California and they got a banknote from somebody, in Florida, how do they know? Maybe they don't know if it's a legitimate note. I don't know about this bank. I mean, so the idea was that you would have the Federal Reserve notes that would take all these notes and then, reissue them as Federal Reserve notes. So it was supposed to be a more efficient system. Of course, the Federal Reserve we were still on a gold standard. All the Federal Reserve notes were backed 40% by gold and other, 100% by commercial paper. And so, it was to make the system more efficient, the banking system, the monetary system. It wasn't there for economic policy. The only thing they were supposed to do is they were supposed to provide a elastic money supply. And what that meant was that when the economy was expanding, the money supply would expand along with the economy. And when the economy was contracting, the money supply was supposed to contract. So they weren't supposed to fight the business cycle. They were just supposed to work with it. But of course, now what they do is when the economy is good, they expand the money supply, and when it's contracting, they expand it even faster. I mean, they do something that never would have been even thought possible back when it was founded. But the politicians have just given the Federal Reserve this task because what they can do is create inflation. That's really the only tool they have, is how much inflation they want to create. They can print money faster, or they can print it more slowly, right? They can suppress interest rates, but none of that helps the economy. All it does is mask some of the symptoms of a sick economy and then making it sicker.
So, Peter, real estate investors do well in the short term when inflation starts to head up, right? Because rents go up and prices go up. But long term, nobody benefits from continued and persistent inflation. So given that, what's an investor to do? And the corollary question, let's talk about what you guide investors to do, both from kind of the equities part and also gold and silver.
Yeah, well, first of all, there are winners and there are losers with inflation. The biggest winners are debtors, because inflation wipes out your debt. It reduces the real value of what you have to repay.
Yeah.
So if you think about that, who is the biggest debtor in the world?
The U.S. government.
Right. So the U.S. government has more to gain from inflation than anybody else. But there's one other factor. Normally, if there's a lot of inflation, interest rates are much higher to reflect that. And as a big borrower, high interest rates would be a problem if you're a debtor. And so what the government has to do is convince everybody that there's no inflation so that they can borrow at low interest rates and then create a lot of inflation. And so the real benefit for a debtor is when you have an unexpected increase in inflation that isn't factored into the cost of money that you've borrowed, right? So a homeowner that has a 30-year fixed rate mortgage that they locked in, at 3.5%, that homeowner is going to make a ton of money over the next 30 years because of inflation, assuming they stay in that home and keep that mortgage, because those mortgage payments are going to get smaller and smaller over time relative to the cost of living. And it's possible that if you make your final mortgage payment 30 years from now, that the number on the stamp that you use to mail your check could be bigger than the number on the check, right? And you've made money not as a homeowner, you've made money as a debtor, right, to inflation. And even if the price of your house goes up over 30 years, it may have gone up more slowly than the price of a lot of other things. But it's the debt. The debt gets wiped out. The losers, of course, are the lenders, right? Who is on the other side of that mortgage? Who loaned you that money to buy that house, and you're making these payments, and they're getting a fixed payment that is diminishing in value every year. So inflation really transfers money from creditors to debtors. So you want to be a debtor. The only thing is you don't want to have maybe adjustable rate debt that could really spike up. Then if you don't have the cash flow to handle that debt, you may end up in a lot of trouble. You may lose the asset that you acquired with the debt.
Definitely a concern for investors who won't do more than just buy a house or two, right? If they buy an apartment building, if they buy commercial real estate, and they're the beneficiary because they are debtors. And we've been talking about that for a long time. It's the part you don't understand, right? That, yeah, the value is different than the price. Well, the price of my house, I paid $100,000 for it. It's worth $1 million. Yeah, but is it really? Right? The value versus price discussion. But the other part is how it affects the tenants. Because if my tenant is suffering through inflation and they can no longer afford the rent, again, whether it's commercial or residential, that's when it becomes difficult for me to make my mortgage payment.
Yeah. When you're in rental housing, right, if inflation impoverishes the potential rental pool, well, then you're going to have to charge lower rent. I mean, you have no choice. You can only charge what the market will bear.
Yep.
And, as people spend more money on food and energy, they have less to spend on their rent. But also what people have to realize when you're on a landlord situation is that families can respond to these pressures, this reduction in their standard of living due to inflation, by, taking on boarders. People could start renting out spare rooms in their house. More people can have roommates. Instead of living by themselves, they could have a roommate. Young people could stay at home longer. They may be that after college, instead of renting their own apartment, they just go back to the bedrooms that they grew up in. Older people can move in with their grown children instead of having their own place. So demand for housing can go down in response to this. And so now there's more rental on the market relative to the demand. You have all these factors, plus inflation is going to be driving up, as a landlord, my maintenance costs are going up of my property. My repair costs that I'm responsible for. Parts are getting more expensive, materials, labor. My insurance rates are going to be going up because the cost of rebuilding is a lot higher. So I have to pay higher premiums. Maybe local taxes are going up with it. So a lot of things can impact you as a landlord, and you may not be able to recoup this. And of course, as interest rates are being pushed up, the value of your building is coming down because, if you're looking to sell rental property, the two important variables are the net rents and then the cap rate.
Yep.
And as interest rates go up, and now you have that higher cap rate, it's going to bring down the value of that property if you go to sell it.
100%. Hey, we saw that when gasoline became double in price, that's the thing that really caught tenants' attentions before they really figured out, eggs and everything else at the grocery store. And there were people who had apartment buildings and had tenants that just had to move or move down. What do you think about wage inflation? We look at the jobs and unemployment and all of that, but that's all. There's a lot of lies in there as well. Can you speak to that, the job market and wage inflation?
Yeah, I think the job market is pretty weak. Yeah, a lot of people have jobs, but a lot of people have more jobs than they want.
Right.
There are a lot of people that have second and third jobs, and they don't have those jobs because they want them. They need them. They can't survive without them. And these are crappy jobs, low-paying service sector jobs. A lot of people who lost good jobs have hobbled together a living by working 2 or 3 odd jobs. But, that makes the job market statistics look better because now you have 3 jobs that were created. Only 1 was lost.
Yep.
So they don't really look at the quality of the jobs. And I think that the wages, particularly in an inflationary environment, wages are likely to rise more slowly than other prices. And the idea that rising wages cause rising prices is nonsense. Wages are themselves prices. It's the price you pay for labor. That's what a wage is. It's a price. And, all prices are going up because of inflation. And the sole source of inflation is the government. It's the Federal Reserve. It's the U.S. government running deficits, the Federal Reserve monetizing those deficits, printing money, buying bonds. All this talk about cost push inflation, wage price inflation, all this stuff is a way that the government tries to point the finger at somebody else, right? They always want to pretend that inflation is rising prices because the government doesn't raise the prices. Greedy businessmen raise their prices. Workers demand higher wages. Putin raises your prices. OPEC raises prices, right? So that's why they want to talk about prices. So they can always get mad. They can act like they're really pissed off about these greedy capitalists gouging their customers, right? But that's not what's going on. It's the government that's creating the inflation, and they're doing it instead of raising our taxes. So it's just a secret way of taxing us, because that's the other benefit of inflation. The government, not just because it's a debtor, but the government gets the money first. The government gets to spend that new money into circulation, right, without having to take it through taxation. So they get to give people money without having to take anybody's money. Now, what they're taking is their purchasing power instead of their money. But, I wanted to make one other point about the rentals and the danger of being a landlord and living in a democracy is that the tenants outnumber the landlords. And so if you're counting votes, you obviously want the tenants to vote for you. You'll give up the landlord vote in exchange for the tenant vote because the numbers are there. And so when things really get bad, like they did during COVID, what'd they say? Oh, nobody has to pay their rent.
Yeah.
Oh, and you can't evict people who don't pay their rent. That's the new normal now. So the next time we have some type of disaster, and who knows what it's going to be, maybe they'll say inflation is so high, people don't have to pay rent. They can't, you can't kick out your tenant who's the victim of inflation. I mean, it's already a precedent that, when times are tough, there's a rent moratorium. So why be a landlord with that kind of risk?
Well, that's why every property is different and every demographic we serve.
Yeah, you got to know your tenant. I mean, I definitely wouldn't want to be in low-income rental units because they're the ones that are most likely to not pay their rent.
And they're the ones most likely to be protected if the government or some division of the government steps in.
Yeah, and you also have to look at where you are. Like, you're in, San Francisco area, forget about it. I mean, obviously they're going to be, you're living out in Texas. There's probably more concern about property rights there than there is in the People's Republic of California, where, there are no property rights. It's just the people, right? The landlords are the evil capitalists who are, gouging these poor people with rent, Simon Legree twisting their mustache.
Well, that's our audience, I suppose, Peter. We're talking with author, economist, podcaster, and fund manager Peter Schiff. When we come back, we'll play real estate trivia and give away one of Peter's excellent books. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Tom Wheelwright, best-selling author of Tax-Free Wealth, and you're listening to Real Estate Guys Radio.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you want to see an outstanding real estate market that still has lots of potential left, well, join me in beautiful Ambergris Caye, Belize. We've been taking folks to Belize for 18 years now, and I have never been more excited about it than I am today. You get all the details on our website at realestateguysradio.com under events. We're talking about the bigger economic picture and why it's critical for real estate investors to understand the economic sea we all float in. We've got the amazing Peter Schiff with us, and before we get back to the interview with Peter, it's time to play real estate trivia. That's a chance for you to win one of Peter's books by knowing today's real estate trivia question. Here's how it works. When you hear the question and think you know the answer, or you just want to guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You'll need to give us your name, the answer to the question, and your physical mailing address, because if you're the first to get it right, you're going to get Peter's awesome book called The Real Crash: America's Coming Bankruptcy and How to Save Yourself and Your Country. It's a big read, but worth it. That can be yours if you know today's real estate trivia question. Last week on the program, we were talking about the Secure Act 2.0 and the ramifications for real estate investors. We asked this: what is the average square footage of new apartments built in 2022 in the United States? Well, according to Rent Cafe, new build apartments averaged 887 square feet, down 30 square feet from 2021. The market with the largest new apartments is Tallahassee, Florida, with an average of 1,182 square feet, while the smallest new apartments are in Seattle, Washington, with an average of 659 square feet. And if you think that's small, the smallest apartments currently under construction are in Spokane, Washington, with an average size of just 494 square feet. Here's our real estate trivia question for this week. Back in 2009, Peter Schiff was encouraged by many local citizens to run for U.S. Congress. In which state did he run? Yep, Peter was a candidate for U.S. Congress in one of the 50 states. Which was it? If you know or you want to guess, send your best guess to trivia@realestateguysradio.com. Tell us the state, and then give us your name and mailing address, because if you're the first to get it right, you're going to get this awesome book, The Real Crash: America's Coming Bankruptcy and How to Save Yourself and Your Country. That's today's real estate trivia question. We're with the author of that great book, Peter Schiff. Peter, let's talk about precious metals. Over the years, we've had you on many panels talking about gold and silver, and lately the market's been interesting to watch. What's your short-term and long-term take on how the metals fit into a portfolio?
Well, I think they fit in pretty well as a liquidity portion, kind of dry powder. Instead of keeping cash, you can keep gold. I think it's a much better store of value. It's an inflation hedge. So if you think real estate is expensive or stocks are expensive and you don't want to buy them now, you want to buy later, hold on to some gold, hold on to some silver. Because I think that even if stocks are expensive in real, in real terms, in nominal terms, who the hell knows? I mean, if you're just holding on to dollars and there's lots of inflation, stock prices could double. But what if gold triples during that time period? So the price of stocks in terms of gold went down, but in terms of paper, it went up. But if you held gold instead of paper, well, you'd have a better buying opportunity because your gold would buy a lot more stock than your paper.
So, a lot of folks who want to have a diverse portfolio look at things like oil and gas and gold and silver and real estate and equities. And at Euro Pacific Capital, you for many years have focused on international diversification. We buy real estate perhaps in a neighborhood or a market that we like, but when we're investing in stocks, we don't look around our town and say, oh, there's a building, let's invest in that company. How do you manage that, and how does risk fall into this idea of diversifying through international companies?
Yeah, well, the way I generally have people get exposure to the commodities you mentioned, like oil, instead of just buying oil futures contracts, we own a lot of oil companies that are profiting from an increase in the price of oil. Big oil stocks, some of the ones that we own are companies like Royal Dutch and Total and BP. Those are big popular companies. We own some smaller ones as well. But those companies do well when the oil price is rising. They can raise their dividend when the oil price is rising. They have larger profits. They can do bigger share buybacks. So, we've made a lot of money over the years through exposure to oil and gas through publicly traded companies. Same thing with agriculture. You don't have to just buy wheat or corn or soybeans. You can buy companies that will do better in a market where agriculture prices are rising. But the main reason that we like to focus internationally and not domestically is, number one, the valuations are better globally. You could get more for your money. Generally, PEs are lower, dividend yields are higher on comparable businesses if they're not in the United States. There's just a premium for U.S. stocks, and I don't think we're going to have that premium forever. I think it's a short-term thing. And so I think you want to avoid U.S. stocks, but also I'm worried about the severity of this coming financial crisis that will be way worse than '08, the recession. I think there's a lot of political risk of potential, windfall profit taxes. So I just want to stay away. And, we're getting into countries that I think are better positioned to do well during an inflationary environment with rising interest rates and higher inflation, particularly emerging markets. I mean, we have good exposure to in that sector, and I think they're going to do really well as the U.S. dollar falls. I think the emerging market economies are going to benefit from that, and the emerging market stocks are going to benefit from that. But, the key is to have the right companies and the right sectors to avoid, certain sectors that are, overpriced. There's a lot of, mob mentality sometimes when it comes to investments. And in fact, if you look at the returns, we have two main strategies, and it's Euro Pacific Asset Management now, really. I don't have Euro Pacific Capital. I sold that broker dealer. And so we kind of retired that name, and now I'm working with the Euro Pacific Asset Management.
Got it.
But our two core strategies are international value and international growth. And we also have a mutual fund that is based on those strategies, which any of your listeners can buy. They can open up an account with us at Euro Pacific Asset Management and buy the funds directly. Or, you have an account at Schwab, Fidelity, any of these brokerage firms, you could just buy my funds, at your local broker. We just got an award from Lipper for the #1 fund last year.
Wow.
Which was my dividend payer fund. In fact, it was #1 by Morningstar as well for 2022 of about 350 funds in the category of international value.
Yeah.
And U.S. News and World Report, they just did a study. They looked at 350 funds and they ranked the top 60. And my dividend payer fund was #1 and my value fund was #3. So the only guy that got in between me was Goldman Sachs, which was #2. But Goldman had other funds that were lower. So I only had 2 funds in the category, and they ended up 1 and 3. And the reason that we're doing so well is because of the stock picking and the sector allocation. And I think that the returns relative to our competitors are just going to really accelerate in the next several years because most people don't get what's going on right now. They don't really understand the nature of this bubble that we've had. They don't realize that bubble has popped. And they still look at central banks as if, they've done us a favor. Like the policies that they pursued following the 2008 financial crisis or following COVID, that they worked. They didn't work. They were abysmal failures. They just don't realize how much they failed. And just like so many people were blindsided by the 2008 financial crisis, they're going to be blindsided by this because they didn't understand the problems back then. And they don't understand the problems now because they're the same problems, only worse. And they were made worse by the same central banks that created them in the first place.
Yeah.
But people still look at the central bankers as our saviors. They don't realize that the fires they're putting out are the ones they lit. But they don't put them out. They just pour gasoline on them. And so they come back bigger.
Now, Peter, you mentioned the dollar, and, everyone knows or should know the trend of the dollar for the last 100 years. It's pretty clear to see which way it's going in the chart. But what are your thoughts on this whole discussion people are having about the dollar and it being the reserve currency and how long that might last?
Yeah. I mean, there's still a lot of people that believe that the dollar is going to continue indefinitely as the reserve currency, and that whenever there's a problem in the world, the dollar is going to benefit from that. And I disagree. I mean, I think that the dollar is going to collapse. I don't think that it can maintain this position indefinitely. I don't even see how it could maintain it for that long a period of time from here. I mean, I'm already surprised that it's made it to 2023 and it's still where it is. But the forces that are going to be bearing down on the dollar are getting heavier and heavier as far as the enormity of our trade deficits and our budget deficits, but also the way we've weaponized the dollar recently, particularly with the sanctions against Russia. This is really highlighting to many other nations in the world how dangerous it is to be reliant on the dollar. And so we're actually pushing countries to abandon it. They should do it anyway. But now we've just given them another reason.
All right. Well, we could go on, and we sure appreciate your insight. If you want to hear more from Peter Schiff, well, you ought to be listening to The Peter Schiff Show. Comes out once a week wherever great podcasts are found. And if you haven't read The Real Crash yet, Peter, you talked about the idea that the bigger crash is coming. When we first had you on the show, you had basically predicted the crash of 2008 before it happened for all the right reasons. And then you said, yeah, but that's not the crash I was talking about. So if you haven't read The Real Crash, pick that book up. Peter, thanks for being on the show today.
Oh, my pleasure. And remember, look, that was from 2013. So this crash is a long time in the making.
We're still waiting.
We've kicked the can down the road.
All right, my friend. Thanks for being with us.
All right, Robert. Thanks a lot.
There's Peter Schiff. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
For thousands of years of human history, silver has been recognized as money. Then in 1965, the United States took silver out of the financial system. But did silver stop being money? Smart investors don't think so. And ever since, when there are concerns about the quality of the currency, alert investors seek shelter in silver and gold. As the size and frequency of major financial crises grow, silver is attracting a lot of attention. To help better understand the what, why, and how of silver, watch the free 9-part series, Making Sense of Silver. Everything you always wanted to know about silver but didn't know to ask. Featuring 30-year precious metals veteran Dana Samuelson. Send your email requests to silverseries@realestateguysradio.com. Whether you own silver now or you're wondering if it's too late, email silverseries@realestateguysradio.com.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hello, I'm Brian Tracy, and I'm here today with Robert Helms. He's one of the real estate guys, and he always has wonderful ideas to share with you that can improve your life, improve your income, and help you to achieve more than you ever thought possible.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. If you haven't already made plans to join us in Belize for the 21st Annual Investor Summit on Sand, you need to do that. All you have to do is check out the website at realestateguysradio.com and you'll see Investor Summit. Lots of awesome folks will be there. Who knows? Peter showed up last year at the last minute. Maybe he'll show up this year, but my goodness, always amazing to get around Peter Schiff.
Yeah, we've been friends with him actually for 10 years, and we first got a chance to really get to know him on the 2013 Investor Summit. And I remember that summit really well because we had Mark Skousen, who runs Freedom Fest, a top-rated economist, another guy named Bob Murphy. And you put me at a dinner table where I had Peter Schiff, Mark Skousen, and Bob Murphy, and we got a chance to talk macro. And of course, my understanding was a lot lower than it is now. I still have a long way to go, but as you know, I've been privileged to get on some panels and hang out with some really smart people. And at least the promoters have thought that I've learned enough that I belong on the panel. I'm not quite so sure, but I have to attribute a lot of that to Peter. And I remember having a conversation with Peter where I put forth an idea, something I hadn't heard anywhere else, but I was reading the news and I said, hey, what do you think about this? And he goes, I really hadn't thought about that, but that makes a lot of sense. And it's right up there with my conversation that I had with Richard Duncan way back at that Robert Kiyosaki event, where I began to understand that just a regular, everyday Joe like me, if you read the news with an open and curious mind and do some homework and really listen to what smart people like Peter Schiff, Daniel DiMartino Booth, George Gammon, folks like that are saying, you can begin to understand the way the system works and you can begin to form investment theses and other ideas about what might be happening and why that can help you make better decisions. So if this is intimidating to you, I just want to encourage you, don't be intimidated by this stuff. It's really, really important. Because your investments live in an ecosystem, an economy. And that economy isn't just people doing business with each other. It's supported by a financial system, credit markets, financial markets, a banking system, currencies. Precious metals, believe it or not, have a role. Peter talked a little bit about that. You really can't afford to be ignorant of how all these things work and how they relate to you. It does take an investment. But as Benjamin Franklin said, the best investment you can make is an investment in knowledge. It pays the best dividends. I think that when you learn to understand this stuff and make better investment decisions, it'll definitely pay you back in spades for the time and effort you put in.
I talked at the beginning how we used to only go to real estate events when we were just the real estate guys and had our book on real estate and had our real estate mentoring club. It was all real estate. And we discovered pretty soon that if you're the smartest person in the room, you're not in the right room. So we have made it our mission to be sure that we are never the smartest people in the room. We surround ourselves with folks like this, and you do have to jump in over your head a little bit and figure it out. And I've watched you do this over the years. I was sitting there with you at dinner with Richard Duncan and just watched you approach him and with your nervousness and all that. And he went, that's a good point. When you have a world-class economist saying, that's a good point, you've been somewhere. And I remember setting up the seating, because I do that to this day for the summit, because I want to have interesting dinner conversations. This is going to be great. I'm going to have Russ there with 3 world-class economists. I remember walking up to that table, and you guys weren't talking about the economy. You were talking about who was hotter on the Brady Bunch, Marcia or Jan.
Well, that was one of my favorite things about getting to know Peter is just what a fun guy he is. He's got such an intense persona. When you hear him speak or you first meet him, you just think this guy is just, he's pretty intense. You're almost afraid to approach him. And then you find out he's just a puppy dog. He's got to be one of the nicest guys. We just have so much fun when we hang out with Peter. He and his wife, Lauren, their kids are just fantastic.
Yeah, so much fun. And, again, it's easy to slough this off and say, well, this isn't center real estate and economics, and I don't understand. And that was us many years ago. But if you will take the time to get your mind around it, real estate operates in an economic sea where all this other stuff also exists. And even though macro can sometimes give you a headache, you'll become a better and better investor. It's why we love to have George Gammon at the summit. He's coming back, and what a smart, courageous guy, but like you, Russ, self-taught, not a big degree, not tons of academic experience, but he's just curious, and he wrestles with the ways that these things interact. And last year's summit panel with you and Dr. Chris Martenson and Danielle DiMartino Booth and George Gammon was a mind blower, because I set it up. I was the moderator, but I was lazy. So I said, hey, rather than me ask a bunch of questions, I want you guys to just ask questions of each other. And it was mind-blowing, because when do you get that kind of opportunity? It's one of the coolest things about the summit. It's not just you're hearing one-way information. Podcasts are great for that. Lectures at events are great for that. But the summit's like summer camp for the affluent. You're hanging out, you're having dinner, you're at the beach, you're having a good time, you're dancing and stuff at night, and you're just, you're forming meaningful relationships, but you're learning in context. There's just a few spots left for that 21st annual Investors Summit on Sand. Takes place in beautiful Ambergers Key, Belize in the month of June. We'd love to have you there. You can get all the details by sending an email to summit@realestateguysradio.com. Hey, big thanks to Peter Schiff. He is a busy dude. Make sure you're checking out the Peter Schiff Show. His weekly podcast comes out on the weekends, and he tears down the marketplace and looks at what's happening and always has some great analogies, like the dog food analogy he shared today. Hey, next week, we've got an awesome show for you and some really great guests coming up. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.